Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 1st, 2024. My mom's birthday. Happy birthday, Mom. I hope you're doing well. I appreciate you coming and investing some time here. Hopefully it will be helpful for you. Boy, what a week we had. Mainly, generally to the downside, and then the last hour of yesterday, we moved straight on up. But anyway, the format of the podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to look at all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, and then most importantly, how I am going to manage these trades in the future, whether they go my way or against me. Once we put on a trade, we really have no control in what the market's going to do, but we do have to know exactly what we are going to do. And the key is that when it goes against you, get out quick. When it's going your way, have a process that you're able to stay in the trade, because we're going to have many losing trades, we're going to have many winning trades, but at the end of the day, we need a few big trades now and then to take care of all the little losses that we are going to have. So you really have to have a process that follows. And sometimes it's hard to stay in a winning trade, but you need to be able to risk open profits to make more profits. But that's really the math of trading. You have to, at the end of the day, you have to have more profit than losses. And so if you're getting out of your losers quick, you can't just get out of your winners quick. You need to let those winners run a little bit and have a plan that tells you what to do. So after we take a look at the trades, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to control your emotions, have a plan, and follow your plan. So we'll talk a little bit about that. After that, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I have identified some trades next week that I like, but they're not there. They're not at the levels where they need to be yet. It's important for me on the weekends to go through my watch list one by one, take it in, big picture, and go, okay, boy, if it got to that level, it would be a 30 RSI, it would be a 200-day moving average, it would be a fair value gap, or it would be a double bottom with a bullish divergence. So that's the important part of trading, is being patient, being able to look at the charts and go, if it gets there, that will be interesting. If it doesn't get there, I'm not interested. I'll just get on to another trade and I'll wait for something that is interesting. And even if it is interesting and you enter the trade, it still doesn't mean that it's going to be a winning trade, but at least you're being patient, waiting for a combination confluence of indicators, certain levels. And then if you're trading correctly, you're going to position size correctly. And if you're wrong, you're going to have a definitive line in the sand. And if I'm wrong, I'm just simply going to get out. And if I'm right, then I'm going to give that some room to breathe. And that's the key. So we'll go. Like I said, I've identified some both on the daily time frames and the weekly time frames, and we'll go through all those. And spoiler alert, I do have quite a few shorts that I'm looking at this week. And then after we do that, we're going to take a look at the indexes a little bit, the Qs, the SPY, and then just take a look at some levels. And interestingly enough, even though we did have that big rally on at the end of the day yesterday, we have broken market structure to the downside, which has not happened for a while. So I'll go through and I'll explain the levels and why really I'm looking for a lot of the positions that I'm looking for are going to be to the short side because of the market structure break on the indexes. All right, so that's the plan. I hope it's going to be helpful. If it is helpful and you find something of value during the podcast, I would really appreciate it if you could hit the thumbs up button. Would really help the channel out, lets YouTube know that there's some valuable content here. So let's get started, and let's get this legal disclaimer out of the way, and I'll be back in just a little bit. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Daily open positions, FXY. I did buy FXY back here on the 20th of May. Why? Well, one of the strategies I really like to use are called abandoned babies or island reversals, and I've had really great success with them. They're not profitable all the time, but in my experience, they're about 70% of the time they're winning trades and about 30% of the time they're losing trades. But the good thing, and the way that I have this set up, is that if they are a winning trade, I'm going to win or make twice as much as I'm going to lose. And if you're winning 70% of the time and making twice as much compared to losing 30% and losing half as much, that's a pretty good proposition, right? So an abandoned bait or an island reversal is when you have a bar that the previous bar before it gapped down. This, for whatever reason, overnight there was some bearish sentiment, bearish news, and it gaps down. The key is if the very next day it gaps up like it did here, so you go from very bearish to very bullish quickly. In my experience, when that creates a bullish abandoned baby, you can also create bearish abandoned babies. But when that happens and you look in the future, more often than not, the price is going to be higher. Here's one to the downside. We gap up, then we gap down. This is a bearish one, and that certainly was bearish. Here is an example of a previous where it gapped down, gapped up. This is bullish. I remember I bought right here. I placed a 2 ATR stop to the downside, and I placed a 4 ATR profit target to the upside, and I reached that profit target easily. This is an example of when you have a winning trade, and so I made twice as much as I was risking. So here we go again. We have a bullish one. We gap down, we gap up. I waited for the price to come back down, fill the gap. I got long 59.24. I placed my 2 ATR stop loss down here. I placed my 4 ATR profit target here, and it is currently down, but it has not reached it's down 0.68%, but it's not reached my stop. And so I'm staying bullish until it hits that. And if it does hit that, I'll just get out. Not a big deal. There's going to be more and more trades in the future where I'm confident that when I take these abandoned babies or island reversals, over the long run, I'll make more money than I lose. And if you'd like to learn more about abandoned babies or island reversals, just go to my YouTube channel. I have a video there on them in the lessons playlist. So anyway, currently down 0.68%. Like I said, just one or two things are going to happen. I'm going to hit my 2 ATR stop, or I'm going to hit my 4 ATR profit target, one of the two. And but currently down 0.68%. Intel. All right, Intel is a new trade that I took on Friday. Why did I take this trade? Well, a little different trade than I normally take, but if you go back and look at this long-term trend line here, you can see that Thursday we closed back over the trend line. And a lot of times when you close back over the trend line, a lot of times you'll go back and retest that trend line to the downside and then move on up. In addition to that, I did have a V1. V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low and then closes above bar 1's close. I did buy that intraday as soon as it triggered the V1, and I saw that it found support at the bullish trend line there. So I did get long 30.29. So currently this particular trade is up 1.85%. My end of day stop is simply going to be a close below the low here at 29.73, and my emergency stop is simply 2 ATRs below my entry. Only about 5% of the time do you hit your emergency stop. 95% of the time, if you have a loss, it's just going to be your end of day stop. I have this orange line up here. What is that? That is called my trailing stop level. That's exactly 1.5 ATRs above my entry. And once it gets there, if it gets there, then I'll go into what is called trailing stop mode, which just means that now if I get there in the future, if I have a close below a previous bar's low, I will exit half of the position, reduce my position size. It essentially moves all my stops up as well because I've reduced the position size. But this one started out pretty good. Bought that right at the right time on Friday, yesterday, up 1.85%. Okay, Adobe. I just talked about trailing stop levels taking half off, and you'll see why that is really, really important. I did buy Adobe all the way back here on the 14th of May. Why? Well, for a few reasons. One, we changed market structure to the upside. We came into this green area, which is a order block, meaning it's the lowest low close before market structure change. We also had a trend line here that we broke above it, just like I talked about on Intel. We broke above it, and then we came back down, got very close to testing the trend line, and we did get to halfway of this big bar up. A big up bar like this, if the price comes back to halfway, you're generally going to find some support there, and that's why I bought that at 468.14. Okay, I placed my 1.5 ATR trailing stop level above, and the next day, so I bought it right near the lows. It moved up, and by the way, your emergency stops, your trailing stops, your end of day stops, these are all considered defensive plays in your trading. But I also like to play offense, and offense means I take partial profits off. I take 10% of however many shares I have at the moment off if it moves the value of 0.45 ATRs. Right now, that's $4.89. So on the day that I bought it at 468.14, I did take off a profit target even that day because it moved 0.45 ATRs from my entry. Then we moved up again on this day here where I took more profit targets. And this is key because look what happened. So it's always important to me to take partial profits as it's moving my way because one, you lock in profits. The market can't take that away from you. Two, you reduce your position size. So if you do have a big move down in the future, you mitigate your loss. And three, you're reducing your position size. And psychologically, it helps you stay with your process. So I'm a really big proponent. I'm a really big fan of taking partial profits. So on the day that I bought it here, 468.14, again, look, it rallied significantly. I took some off. The next day, I took some off. And we got to trailing stop level. Then we moved around here. Nothing really happened. Here on the 23rd, we gapped up, took some more profits off, which is important because of what happened. So I kept reducing my position size. The next day here, we closed below the previous bar's low. I sell half of what I have remaining. I took profit targets, so that reduces my position size, right? And then here, like I said, on the 24th, we closed below the previous bar's low, and I locked in a gain of 1.6%. Next day, move sideways. Next day, up a little bit. And then on Thursday, we come all the way down. When the market was going down, I hit my emergency stop. Don't often hit it, only about 5% of the time. But I have to adhere to it and had a loss of 4.41%. But does that mean I lost 4.41% on the trade? No, I didn't because I took profits. I took profits on this day. I took profits here. I took profits here. I sold half here, which was very important because again, it keeps reducing and reducing and reducing my position size. Not happy that it hit my emergency stop, but these things happen. But it just goes to show you why taking partial profits when you have them is an important thing to do. And ultimately, if you have a crash down like this, it really reduces. So on the remaining shares here, lost 4.41%. Okay, ITA. I got short on the 28th of May. Why? Well, this blue up bar here, this is an order block. We lost a trend line. We checked back into the order block. I got short here 135.60, nailed the top, moved down. I took profits during that day. I took partial profits during that day. Then the next day, down again substantially. I believe I hit two profit targets at that point. So now at this point, I've taken 30% of the position off, which is key because of the rally. But I took 30% of the position off at profitable levels. I did get to trailing stop level here, which now, because I'm short, means that if I have a close above a previous bar's close, I will get out of half. Next day moved up, but didn't take out the high. And then we had this huge rally on Friday where this obviously closed above this high, and it closed above my entry for a loss of 0.37%. So I took off half of the position now. So it says I'm down 3.7%. Am I? No, I'm actually up on the trade still because I took the profits off while it goes my way. I really think it's important, for me at least, to take partial profits when I have them. It changes the whole calculus of everything. So the remaining shares that I have, if it closed above this high here, 136.89, I'll simply, that's where I get out of the trade. But if it turns back down, then I'll just continue to take partial profits. But again, very grateful that I do, especially on this trade, that I did take profits while I had them. And the taking the half off here at a very small loss of 0.37%. But again, overall, I'm still profitable on the trade because of the taking of the partial profits. Okay, so as far as the daily goes, FXY, so not a great stellar week, but they aren't at all times. But we'll see what happens next week. So FXY currently down 0.68%. Intel up 1.85%. ITA, the remaining shares down 0.37%. And Adobe was the big dog to the downside, down 4.41%. Let's go over to the weekly trades that I have, and we'll take a look at that. Weekly trades close on Friday. So I make my decisions on Friday, unless, of course, I hit my emergency stop and then I get out immediately. But I did short IBB back on May 17th. Why? Well, again, the blue up bar, this is the order block before the market structure change. I took the trade when it came back into the order block and also rejected the 200-day moving average above me. So there were no more buyers up there. I did get short 136.69. The next week started off, went against me, went above the 200, but I wait for the close, came back down, closed under, and then this week moved to the downside nicely, moved enough to the downside where I did hit two profit targets, took 20% of the position off. I'm not to trailing stop level. My end of day stop is end of bar stop is simply going to be a close above these highs here, 137.87, and then of course my emergency stop is up here at 146.30. If it does continue down next week and get to my trailing stop level, then at that point I'll go into trailing stop mode, and if I have a close above a previous bar's close, then I'll get out of half. But anyway, this trade doing okay, up 2.05%. Okay, so those are the open trades. Let's talk a little bit about trader psychology. This is from my good friend and mentor, Steve Burns. You can follow Steve Burns over on Twitter at @JosephBurns. He's a great trader, a great coach, a great teacher, a great author. He has many great trading books. You can check them out on Amazon. But let's see what Steve has to say. Trading is the intersection of math and psychology. It's true. Why math and psychology? Okay, math, well, position sizing based upon what the account value is, what the volatility of the market, what your ultimate position size is going to be. That's math. Your risk to reward ratio. Hey, if I lose, I'm willing to lose $1 to make $2. That's math. So there is a lot of math involved in trading, position sizing, risk to rewards, but there's also the psychology of being patient, waiting for your trade, following your trade plan. So it really is the intersection of math and psychology. It's not just one, but both. And that's why trading is the great game in life. It's fear and greed and, trying to be patient and doing the right thing. But, my best advice for anyone is to be extremely patient, position size based upon your account value and what the volatility of the market currently is. It's very, very important to do. But trading is not for everyone. You have to have the right mindset of you know having a proper plan so that if you're wrong, you can be wrong small. If you're right, you have the ability to be wrong big. Being very impatient with your losers, being very patient with your winners. You hear this all the time, but you really, really need a plan. So go find yourself a plan. Go find yourself a process. If you'd like to work with me, I teach private one-on-one lessons in the evening time via Skype. I've been teaching for many, many years. I've taught people from all over the world. I have a plan. Doesn't matter what happens in trading or what happens with any particular market. I know exactly what I am going to do, and I'm very happy to teach that to you. If you're interested, just send me an email. I also teach you all the trading strategies, but I really enjoy trading, and I've taught some great traders in this world. So if there's an interest, let me know. But again, thank you, Steve. Trading is the intersection of math and psychology. It is really, really true. Okay, let's head over and take a look at the potential trades for next week. All right. DoorDash, DASH. Well, DoorDash has been in a downtrend for quite a long time, but we are coming to some important levels. And that important level right here is that 200-day moving average and that negative third ATR channel. I have a course, an online video course called the Deep Dip Buy Stock Trading Approach, and this is exactly a potential deep dip buy. And by the way, if you'd like to get that course, it's on udemy.com. The link's in the description. It's a really, really great course. But here, again, the black line is the 200-day moving average, the negative third ATR channel. 92% of prices do tend to stop going down or bounce when it gets to the negative third ATR channel. But this is the intersection of the 200-day moving average and the negative third ATR channel. In addition to that, we have a double bottom bullish MACD divergence. This is basically just showing that some of the selling pressure is starting to abate and running out. And if you run out of sellers, well, basically the implication is that the market's going to go up if you run out of sellers. If you run out of buyers, and it's the same thing, implication is we're going to go down. So this is the level that I'm looking at right here, right now, right about 103.95. So there still is some potential downside here. But if we go down, bounce at that 200, intraday reject the 200, or have a close under, close over, this really makes sense to me. And this is what I'm talking about as far as looking at a chart and going, where would I want to buy? Well, right there, 200-day moving average, negative third ATR channel, but I want to see the price test it first and have the market tell me that it is not, doesn't want to go any lower. So that's what I'm looking for on Dash next week, a rejection of the 200-day moving average. Doesn't mean it's going to be a winning trade, but it gives me a specific level to base my trade off of and know, hey, if it bounces the 200, I'm in as long as it's over the 200. If it closes under, I'm simply out. But a lot of confluences there. 200-day moving average, negative third ATR channel, double bottom bullish divergence. I like it, but I just want to see the 200-day moving average tested first. All right, Google, GOOGL. Well, you see a red bar, a red zone up here. What does that mean? Well, that means that this is an area that I'm looking for to short. You can see this trend line here connecting these bottoms. Well, this week we did break to the downside. Just because you break a trend line to the downside doesn't mean it's immediately going to go straight down. But what often happens is when you break a trend line to the downside, a lot of times you'll rally back up a little bit before you have a move back down. I don't know if that's going to happen, but I see it all the time. You know, I day trade all day long, and I see these patterns repeat themselves all day long. And by the way, I've been trying to put out a video every day on YouTube, just some of my intraday trades. I mean, if you look back during this week, you'll see this exact same thing. These are the daily charts, but you know, I usually trade on the 5-minute charts. You'll see these trend lines broken. You'll see a check back in, maybe back up to the trend line, and then a big move down. I had a big trade yesterday on NVIDIA using this exact same principle. So we broke the trend line to the downside. In addition to that, we did break market structure to the downside. You know, taking out this low here puts us into a bearish market structure. Here is the bearish order block. I know it doesn't look bearish, but it's the highest up close before a change to the downside. So we have two serious levels of resistance above us. We have the trend line. We broke it to the downside. Now it's resistance above us. And we also have this bearish order block. So next week, Google, and I can't tell exactly how I'm going to do it, whether if it, you know, theoretically, just as soon as it gets to the bottom of this order block, I could short, but I'm just going to have to wait and see what the price action is. Maybe I get a V1 to the downside. Maybe we reject this trend line, and that's where I get short. So it's just basically a zone somewhere between 175.80 and 178.08, you know, $2.75 or something. But this is the area that I'm looking for. You know, we had this big down bar here on the 23rd. If we rally back up to halfway of that, you know, there's going to be resistance there also. So really, I'm just going to have to wait and see, but this is the area that I'm looking to short, potentially on Google, anywhere between 175.76 and 178.19 or something. But in this area, and I'm just going to have to wait and see what the price action looks like, but this is the zone that I'm looking for. Home Depot. Okay, well, Home Depot had a deep dip by valid buy signal on Friday. Why? Well, because we went under the previous day we closed under the 200 and then closed above. By the way, I just noticed this here. Look at that. That is a bullish island reversal. We gap down. Very bad sentiment. Next day we gap up, leaving this little guy down, but this little baby down here by itself. And did it work? It certainly did. So I did not buy this on Friday. Why? Well, you know, we've had these two big days up. I just feel like it's a little bit chasey right here. I think it's a little stretch. You know, I like to get a good risk to reward ratio like over here. This is a good risk to reward ratio, right? We go under the 200, over the 200. So my distance to my 200 is very close. So, you know, theoretically the next day, even if it closes below just a little bit, I'm out for a very small loss. That's what I'm talking about, having a good risk to reward ratio. This is quite extended. So what I'm looking for next week, potentially on Home Depot, is a little bit of a pullback and a retest of that 200. You know, a lot of times you will retest that 200, and also the other reason for waiting, that if it pulls back, then I ultimately have a better risk to reward ratio. So I'm just looking for a retest of that 200 next week to potentially get long. Here's the Russell. Russell 2000, well, here's a red band up here. Why? Well, again, we have an order block, highest close before we change market structure. And again, the trend line, the bottom here to the bottom here, we broke it to the downside. So we did break the trend line to the downside. Doesn't mean you want to immediately get short, but the change of the market structure by taking out this swing low, the change of the market structure by breaking this trend line to the downside. Now that we're in this technical downtrend, the right move for me is to short rallies. You know, if you're you want to buy dips in an uptrend, you want to short rallies in a downtrend. Well, breaking the trend line, changing the market structure to the downside, this, in my mind, at least the way that I trade, this does put us in a bearish market structure. So I want to short any rallies. Well, the ultimate place here is the high of this order block, which is 209.77, and the low of the order block, 207.72. Anywhere in this location would be a potential short area for me. And that's what I'm looking for. And by the way, I have 15 symbols here. Does that mean that, theoretically Monday, all of these could trigger all at the same time, but I still am only going to take one. So, I have quite a few shorts here. Doesn't mean I'm going to pile into every one. I'm going to buy, I'm going to short the one that has the most confluences. Which one has the best risk to reward ratio? Which one had the multiple um, entry signals? Which one had the best or the worst relative strength on the market? Which one looks better on a higher time frame? Because I don't just look at one time frame, I look at higher time frame. So, it's a bit of a, like grading a report card of all the things I just mentioned. And by the way, this is what I teach in my private one-on-one courses. This is an important part. You have 5 candidates. Which one's the best? Well, that's what I teach you to do. And that's what I'm looking for here. Again, I have 15 symbols. So I'm not going to take all of these if they trigger on the same day. I'm just going to look for the one with the best risk to reward ratio, the most signals, looks best on the highest time frame. So Russell, yeah. And by the way, if we make it back to the highs here, I can already tell from a MACD perspective that if we do come back up, challenge these highs, we'll have a significant bearish divergence, MACD divergence. And that just means you're running out of buyers. So this change in the market structure here doesn't surprise me that this dip got bought, because when you're an uptrend, these dips usually get bought. But if these buyers come back up, if the buyers that bought this dip, if it comes here and fails and doesn't make new highs, then they'll probably get antsy, get out of the trade. That will bring new shorts in. And so you'll have two groups with selling pressure. The dip buyers, where it failed, they'll get out, and you'll have the new shorts, they'll get in. So you have 2 groups that will be pushing the market down. That's why when you break market structure, people usually buy that first dip, and then if it gets into the fair value gap or gets into the order block, they'll bail, and that's why generally you get a longer leg down after you've checked back into the order block or the fair value gap. So for IWM, again, I'm looking for a potential sort somewhere between 207.70 and 209.71, somewhere in this area. But I'll know it when I see it. But that's what I'm looking for, short on IWM. Coca-Cola, same thing. Again, red band up here. Why? Well, here's your highest close before market structure change. Again, if we and then here's the trend line connecting these lows here. We certainly broke it to the downtrend. Now we're coming back up. It may not even get to the order block, but I'm looking for a short somewhere between 63.15 and 63.65. So somewhere in this area, looking for a potential short. Southwest, again, looking for a short. Here's your order block, your bearish order block. We change market structure, down, 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 down. Yes, the dip buyers came in here, but if we get somewhere between 27.65 and 28.22, we will be in this bearish order block, and that's why I'll look for potential short. Qs, all right. Well, again, it's exactly the same thing. Sounds like a broken record, but look, long-term trend line broke to the downside. And this is important. We have not had a structure break to the downside in a long time, but here we go. On Thursday, we broke structure to the downside. We took out this swing low and then continued down. Yes, we're having this rally. I'm not surprised, but I'm looking for a short on the Qs somewhere between 456.50 and 460.49. So I'm not saying that we can't rally back up. Very likely we probably will, but this will be the area that I will be looking for a short. Silver, no, same thing. Bullish order block, I'm sorry, trend line here. We broke trend line to the downside. Here's the highest close here. Here we have the trend line. Again, now we're below the trend line. Doesn't mean I just go ahead and short here, but it means that from a trend line perspective, we broke structure to the downside. If we rally back up to that trend line, in my experience, that's the place that you want to take a look for a short, because now that trend line is above you as resistance. So I'm looking to get short silver somewhere between 29.49 and 28.83, somewhere in this area. Virgin Galactic, this one. This one, I've been talking about this one on the podcast for a long time. And I said, look, here is your bullish order block, which is your lowest low close before you have a market structure change. And then if it comes down to the top of that bullish order block, right here about 84 cents, that's where I would be looking for a long. And this was here on the 24th of May. I almost got in there. I mean, it literally got a couple pennies away from me getting in. And the next day it takes off for 20, 22, 23%. I was like, oh my gosh, I missed it. I missed it by one day, but it's okay because I said, look, I'm only going to get long if we test the top of this order block, which looks like it's 84 cents, and it didn't get there. So I followed the rules. I did what I was supposed to do, but sometimes those things happen. But now we've come all the way back down. So next week, I will consider getting long SPCE if we reject the top, at least reject the top of this order block at 84 cents. SPY, okay, well, again, the general market trend line last week, we broke it to the downside. Okay, that's important. We haven't done that for a while. Also, we broke market structure. We took out this swing low. So this puts me into a bearish category. But again, just because it's a bearish category, I don't think it's going to go straight down. Many times when you break structure to the upside, you'll head back down. Many times when you change market structure to the downside, you'll have an attempted rally before the longer leg down. And this is very clear. We have this trend line that we broke. If you break the trend line to the upside, to the downside, and then rally back to the trend line, that's generally a good place to short. In addition to that, we have the bearish order block, the highest close before we break structure to the downside. So I'm looking to get potentially short SPY at somewhere between 528 and 531. And again, if we do get back up to these levels, I can tell from the MACD that we are going to have a bearish, we'll have a double top, a bearish divergence. So there's all sorts of signals, in my opinion, that show that yes, we may have a rally back up, but a lot of technical damage was done to these charts with the loss of trend lines, the loss or the start of bearish market structures. So as you can tell, I'm pretty bearish. Even though this looks bullish, this is the area that I'd be looking to short from 531.73 to about 528.43. Tesla. Okay, so Tesla, you can see we've been moving sideways, and here's an important thing. Overall, in all markets, sideways motion leads to trends. Trends lead back to sideways motion. So this is telling us something here. This is telling us that the market has not decided which way Tesla wants to go. But we have the beginning, the formatting of a nice potential trade, and this is called a return to value V1 or V2. The green line here, anywhere in here is considered the value zone. The requirements on this trade is you have to close above the value zone, which we did. The second requirement is you have to come back into the value zone, which we did. The third requirement is that you need to be moving sideways, which we are. This is all legitimate to get long if and only if we have a V1 or a V2 entry signal. A V2 is two bars, bar 1, bar 2. Bar 2 has to go below bar 1's low and then close above bar 1's close. Or a V2 is 3 bars, bar 1, 2, and 3. 2 goes below low, bar 1's low, and then 3 has to close above bar 1's close. And like by the way, if you'd like to, really get into the details of these entry triggers, again, I have that on my YouTube channel. Just look in my YouTube channel in the lessons playlist for V1s or V2s. But this is all formatted for a potential trade here. I'm just looking for a V1 or a V2. You can see on Friday, we did take out bar one's low, but we didn't close above bar one's close. So theoretically, on this coming Monday, we could have a V2. If Monday's bar closes above Thursday's bar here at 178.79. So it'll be interesting to see. But again, sideways motion leads to trends. Trends lead to sideways motion. We have sideways motion, and we are returned to the value zone. So if I get a legitimate V1 or a V2 next week, it's potential I could get long Tesla. United Airlines, UAL, okay. Well, has a red band here. This means that I'm looking to potentially short. Why? Well, we broke market structure to the downside, and when you break market structure to the downside, you want to short rallies. Well, we certainly broke it to the downside. Now we're having a bit of a rally. If we get into this red bar zone somewhere between 53.51 and 54.49, somewhere in here is potential short. I position size. I place my emergency stop 2 ATRs above, and where would my stop be? My stop would just simply be a close above these highs, because if we close above that high, then we go into a bullish market structure again. But currently, this is just a rally in a bearish market structure, and that's why I'm looking to short here. Okay, VIX. Okay, well, VIX is kind of interesting. VIX is volatility. VIX usually goes against the grain of the market. And what I told you about on the Nasdaq and the S&P 500 is, we were in an uptrend. We broke the structure to the uptrend, and now we're having a rally, or we're having a check back into those bearish areas. Well, VIX is telling exactly the same story, but to the opposite side. We had this huge downtrend. Then we broke market structure to the upside. We also broke above the trend line. But now that we've broken structure above, waiting for a pullback. Now that we've broken structure, broken the trend line from under to over, now looking for a pullback. So if we were to come back and back test this trend line, that is where I would consider getting long. In addition to that, I talked about double tops, bearish divergences. Well, this is the opposite. If we come back down and test this low here, we will have a double bottom bullish divergence, meaning that this low here has these large red MACD bars to the downside. Now, if we come back down and test these lows, I can just tell we won't even have any red. This is called a double bottom with the bullish divergence and a missing right shoulder. So the VIX is telling me here that yes, we had this move up. Now the market's rallied a little bit, so VIX is going to move down. But if VIX moves back down to these lows and we have a double bottom bullish divergence, it means that we're running out of sellers on the VIX, which would indicate to me that VIX could have the potential for a larger move up. And that dovetails exactly with what I'm talking about on the markets, with breaking market structure to the downside. Yes, having this rally, but if this rally fails, then the markets will probably have a leg down. So the technicals on the markets, the SPY, the NASDAQ, overlaid those onto the VIX here, it all makes sense to me. That's why I'm very suspicious of this move back up on the markets, and that's why most of what I'm looking at is too short. But if VIX does come back down, back test this trend line with this double bottom bullish divergence, I would definitely consider getting long VIX. XLF, same thing. All these charts look the same. Here's our bearish order block, highest close before market structure change. Again, trend line here significantly broken, and now so we're in a bearish market structure now, looking for a check back somewhere between 42.51, 42.16, somewhere in this area. Definitely I would be looking for a potential short. Another thing to point out here, we have this big down bar on May 20th. Well, big down bars, if you rally back to halfway, generally have resistance. Look, on the very next day, we had the big down move. We rallied back to halfway, right? From the high to the low, we rallied back to about half. It's exactly where it failed. So if we get there again, will it fail again? Obviously, I don't know, but I do know that when you get to halfway of a big down bar, there is some potential inherent resistance. And again, that dovetails with the bottom of this order block here. So, definitely somewhere in this area right here, I'll pretty much take serious the short of getting, I'll take serious the idea of getting short at these levels. And then XLRE, real estate, okay, same thing. And look, this one was perfect. We have a bearish order block. We changed market structure, move all the way back down. Last month, we got right to that order block in the red area. It's exactly where it failed. Like perfectly. Just got there. I didn't take the trade. Just got there and then failed. And now we're heading back up there again. Will it hold this time again and do the exact same thing? I certainly don't know. But, if I would say it's more likely to do that than it is just the blast through it. So I would potentially be looking for a short on XLRE at 38.80 up to 39.22. And one more thing before we get to the weeklies, I'm making my case of why I'm suspicious of this rally. Let's go over to bonds as well. Okay, so bonds interest rates are really what's driving this. This is TLT here. And you can see when, the more TLT price goes up, interest rates go down. The more TLT price goes down, the more interest rates go up. So at the beginning of last week, we had this huge move down on bonds, which makes interest rates go up. Interest rates goes up, the market doesn't like it, right? And so the last few days we've had this rally, but look, we're getting close to rallying to halfway at this big down bar. Okay, we have this trend line here that we broke to the downside, and now we're rallying back up to it. We're also in a fair value gap. So if I have to look at objectively at bonds right here, it looks more bearish than bullish. And if I am right on the bullish case, I mean, it could go up a little bit more, but if it goes up, then the market will probably go up. But again, we're getting into these bearish areas, so that if we do fail from here and go back down, that dovetails with the analysis on the S&P and the Qs that most likely, if TLT goes down, interest rates go up, that the markets will probably go down with the higher interest rates. So this is, I'm just looking at all the drivers of the market. TLT is very, very important. But again, we're getting into a bearish area here on TLT, which wouldn't surprise me at all if they come back down, and that will probably take the market down as well. And that dovetails with the analysis and the technicals of what's happening on the dailies. Okay. Let's take a look at the weekly trades. Weekly trades happen on Friday because that's when the bar closes. And again, Apple, looks like I'm a perma bear here, huh? Almost everything I have is bearish. But if we look on the weekly on Apple, we have this bearish order block. Highest close before market structure change. We broke structure here. Apple got right back into the red area, and that's exactly where it failed, and it failed hard. Again, we're back in the red area. Does that mean it's going to fail this time? Not necessarily, but again, the market didn't like those areas last time. Things change. But what I'm looking for is a potential short on Apple at 194.50. Right now we're at 192.32. Why did I pick that price? Well, here we have this big down bar back here on the 22nd of December. Last year, big down bars, if you get back to halfway of those, there's some inherent resistance. I mean, you can see exactly. Look, we had the big down bar. We basically tested that area and failed. So there's two things. There's the big down bar, and we're in this bearish order block. So we're in the order block right now. I could short right this second, but I don't want to. I want to really wait for my level, because the higher I can short in the order block, the better risk to reward ratio I have, because my end of week stop would just simply be if we took out this high and made all-time highs. So I'm considering getting short Apple here, 194.50. But again, I have 7 symbols here that I'm looking for, and I'm only going to take one on these weeklies. I'm only going to take one per week, so I have to narrow it down. Which one has the best risk to reward ratios? Which one looks better on multiple time frames? Which one had more signals? These are all the things. And again, these are all the things that I teach in my private one-on-one lessons. So, if you're interested in taking my course, I promise you'll be a much better trader. You're going to learn a lot of things. I teach you step by step every single thing that I do in my trading, and I'm happy to do it. And I love to see when my students have those aha moments and put them together. So if you're interested, my email is in the link of the description. Just reach out to me and we can start to talk. Budweiser, okay, well, finally something long. Here we have a bullish order block. We have our lowest low close before market structure change. So we've changed market structure to the upside. If you change market structure to the upside, you want to buy the dips. If you change market structure to the downside, you want to sell the rips, or you want to sell the rallies. So what I'm looking for on Budweiser, and I'm not dying to get into Budweiser, and you should be the same with any of your trades. Pick the levels. If they get there, then you can consider taking the trade. If they don't get there, then then you don't take the trade. So where am I looking for? Budweiser, if it gets here somewhere between 60.19 and 57.87, that's kind of a large area there. If it gets there, I'll consider it. And, really the area would be perfect would be the 200-day moving average, the black line, right? Deep dip buy. Why? Well, for one, it's the 200 just by itself, and two, it's inside this bullish order block. This makes sense. So will it get to 58.93? I don't know. But if it does get there, I will certainly consider taking that trade. Absolutely certainly consider, because there's so many confluences. We have the 50 crossing over the 200. Anytime that happens, the first pullback to the 200 is generally a good risk to reward ratio. We have this bullish order block here as well. Yeah, totally makes sense. So ideally, the spot would be 58.39. It's still a ways down there. But hey, listen, even if we bounce off the top of this order block, I would consider getting long as well. So just being patient, not dying to get into Budweiser, but if it does come down into this area here, I would definitely consider getting long. Walt Disney. Okay, well, Walt Disney. We've broken market structure to the downside. We have a big down bar here on this weekly bar on May 10th. Big down bar. Well, if we get to halfway, there's going to probably be in some inherent resistance. Not always, but a lot of times. In addition to that, the red highlighted area is a fair value gap. There's a gap here that the market hasn't tested. So I'm just going to go ahead here and say somewhere between 106.92 and 110.32. Ideally, the real place would be 110.32 because it's halfway at the big down bar. If I did take that trade, my stop would be a close above this big bearish engulfing bar. It's going to be hard to get above that 116.85. So just somewhere in this area, 110.30 to 106.83. We might get into this big down bar, have a V1 or a V to the downside. That could also be a potential entry. But just for the podcast, 110.30, a rejection of 110.30, I would certainly consider getting short Disney. MasterCard. Okay. Well, I was talking about return to value V1s, V2s. Here we go. This is perfect on the weekly. Green line, green line. This is our value zone. We need to close above the value zone. We did. We need to come into the value zone. We did. We need to have some sideways motion. We have had that for the last month. So now it's setting up for a legitimate entry next week, but next week only if we create a V2. Here's bar 1. Bar 2 goes below bar 1's low. Next week, if we close above 451.18, we will have a valid return to value, sideways motion, V2 entry. So this one's pretty simple and pretty black and white here. If we close above 451.18, a legitimate return to value V1, V2 would have been formed. Meta. Okay. Again, to the short side. Bearish order block, highest close before structure break to the downside. Structure is broken to the downside. Now I want to wait for a rally. Well, the bottom of that order block is going to be resistance. And you can see exactly. A couple weeks ago, we basically touched it, went down. This week, we didn't quite get there. My area that I'm looking for is 495. Why? Because we have the big down bar here back on the 19th of April. Big down bar. If we get halfway back to that big down bar, just that by itself is going to be a resistant area. But in addition to that, the halfway is also going to be in this bearish order block. And my stop would simply be all-time highs here. Pfizer. Okay, well, Pfizer, bullish. We changed market structure here. We had a low followed by a low. We took out the swing highs. We are definitely in a bullish market structure now on Pfizer. When you're in a bullish market structure, you want to buy the dips. I've been talking about, changing market structure to the downside, selling the rips or selling the rallies. This is the opposite. We have changed into a bullish market structure now on Pfizer. I'm waiting for a pullback. Where would be the right place to buy this pullback? It would be in this fair value gap between bar 1, 2, and 3. The low of bar 3 is 26.99. The high of bar 1 is 26.19. So basically somewhere in this green shaded area right here, 26.99-ish to 26.13-ish, somewhere in this area. If we have a pullback and we get into that area, this would be my potential buy area. I keep talking about getting back to halfway, the big up bars or the down bars. Well, this one, look, we have this huge up bar here. If you have a huge up bar and come back to halfway, that would have inherent support, and in addition to that, you're inside a bullish fair value gap. So 26.30 would really be the level that I would look to potentially get long Pfizer. And then last but not least, on Tesla, this orange line here, this is the 300-week moving average. Back here on the 26th was legitimate entry because you have a close under, close back over. It came from a lower low, still legitimate, but I like higher low everything. So if we were to come back down, test this 300-day moving average, giving me a good risk to reward ratio, I would potentially consider getting long Tesla. So I know we went through a lot of stuff today. As you can see, big picture, I'm a little bit more bearish than anything, but there are some things like Pfizer, and Tesla here that I am potentially looking for some bullish things. But I hope this helped everyone. As I mentioned, if you're interested in private one-on-one lessons, I have a course, 15 hours. Each session is 3 hours, and we do 5 sessions. So we have a total of 15 hours. I teach you step by step all the approaches that I've used over the last 28 years as a full-time professional trader. It does cost $1,750, but it's an investment in yourself. You'll have a skill that you can use the rest of your life. And if you're interested, just send me an email. Generally, what I like to do is I like to just have an initial call with a prospective client. It's free, no obligation whatsoever. I just like to get to talk to them, get to know them, learn a little bit more about them and their trading and their challenges and their goals. And it's a great time then for them to ask me any questions about the course. And then once we're done with the call, that's it. No pressure whatsoever. When we're done with the call, we're done. And then you think about it. And then if you decide you want to start one day, just email me back. And we've already spoken, and we'll get it on the table. But I think you really like it. Like I said, it is an investment, but and this kind of leads into the next thing. If you're not in the financial situation to do the one-on-one, a really good secondary option is the Udemy course that I have. It's very, very affordable, extremely affordable. It depends on the day, but I think it's somewhere between $15 and $35, depending depending on the day. But the course is great. It's 9.5 hours of video, 26 videos total, 15 different study guides, and I take you through and teach you step by step exactly how to use the deep dip buy strategy. And I always like to leave off with, try to go out and do something nice for someone today. You never know what's going on with people, what's going on with their lives, and just a random act of kindness here and there really could make someone's day. I like to do that for animals as well. I was raised with many animals, and I know they appreciate acts of kindness as well. So, one nice thing for a human, one nice thing for an animal. You like it when it happens to you, so why not kind of pay it forward and improve a person's or an animal's day as well. So I really appreciate you being here, everyone. If you have any questions about anything, feel free to write them in the comment section. I'll do my best to reply to them. But God willing, I'll see you next week, and we'll talk about these crazy markets. But be patient, get out when you're supposed to get out, and I really hope you have a good rest of your weekend. Thanks, everyone. I'll talk to you soon.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.